Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah. Now, we've been talking about the CapEx cycle and what it does over the medium term. We had some long format interviews, and it's only apt that today, on the day after they posted a very good set of numbers, that we speak to Thermax. Both top line, bottom lines were beaten. Margin performance looks strong. A lot of things to talk about. To Ashish Bhandari, he's MD and CEO of Thermax, as he joins us to tell us how does he feel about the current cycle and how would Thermax benefit from the same. Ashish, great having you. Thanks so much for joining in at the onset. Congratulations on a very healthy Q4. Arguably, I would say a fairly decent FY23 as well.
Neeraj, thank you very much. And I would concur. It was a good year, especially given how we started. Yeah, the first couple of quarters, there was strength all around, but the commodity price moves had us all kind of concerned around how are we going to manage through? And it all stabilized in the last 6 to 8 months. Overall, a good year, yes.
Okay. Ashish, may I start off by trying to understand what you felt per se? I mean, what was the standout feature in the quarter for you on the positive side? Were there some chinks in the armor? A couple of notes have written about how order inflows may have been slightly lower than what they were factoring in. Would you talk a bit about that?
So I think let me take the orders one first. Yeah, I think the orders one, I've been saying it for some time that we don't see too many big orders that we are bidding on. And so we didn't expect too much that was going to come in to report. So in that sense, there was no negative surprise. I would agree, though, that if we have to stay on the growth path and what we have done over the last couple of years, we do need some mix of bigger orders starting to show up again to drive that top line. Yeah, and at least and as you know, we have now redone our segments. And in the portion where we report some of those larger projects, we do need to continue to work that backlog. Because we know with volume, we also get some amount of throughput and productivity in that overall space as well. So if you're looking for a chink in the armor or that particular question, getting some movement out there, and which I think can happen as we go through the year, not in the immediate future, but as we go through the year, I do look forward to getting some of the bigger orders back in play. In terms of what went well, I would say almost everything else went well. Yeah, we had a good quarter from an execution perspective. Chemicals, which was a business that we were working through a cycle, we had a lot of internal actions. We had a new plant that we had to stabilize. We were able to stabilize all of that. On the product side, our services business grew quite nicely. Some of our newer programs on digital and all were starting to catch legs. And lastly, I would say we reported now a green solutions business, which is where some of our build, own, operate and our longer asset plays will show up. That part of our business right now from a numbers perspective is a drag. But we like the long-term potential. We like the work that we are doing. And that is an area where we will continue to invest. From an execution point of view, that business did very well last quarter. So that was one more positive.
Got it. Just a quick follow-up on the first part of your answer. So I'm just trying to think if you are doing things differently for you to not get some of those large orders. Is it happening in some portion by choice because you are not trying to get into areas which might be of lower returns, lower IRRs, or lower margins? Why is it that it is taking so much time to get the large orders?
Two answers. Yeah. Two answers to the question. First, in terms of the overall, our biggest projects from a top line perspective tend to come from refining and petrochemical, and to a smaller extent from power. The portion that comes from power is typically the FGD kind of projects, and then also some of these larger coal projects that happen. In that particular portion, we have ourselves taken a step away, focusing more on waste to energy and kind of biomass and other segments, and saying, look, this is not something that we think is a long-term focus. So from an overall project and a space perspective, we have taken a slight step away from that. On the refining and petrochemical, we have a cycle going through. We went through a big chunk of projects, and I would say there we also had some pricing decisions where we walked away from a couple of things. But as things stand right now, we don't even have too many big projects going through. Yeah, all of India has been waiting for that West Coast refinery to show up. There's some other projects in Paradeep and other places which are announced. CPCL in the south has got a couple of projects, but they are small in the grand scheme of things compared to like when Reliance goes through a big expansion, or HRRL, or some of these other projects that we have had. So I think no one answer, but a mix of both of those things. Yes, some of it is our own calculated moves away, and some of it is just the nature of these cycles. And we are going through one where the cycle is shifting. If I may just elongate on my answer a little bit, where we are seeing the cycle develop now is more around some of these new energy spaces, and in spaces like steel. Steel, though, is a little fickle. Yeah, if you see a big pipeline emerging in steel, sometimes those projects don't go through. But in refining and petrochemical, typically there's a lot more certainty of projects going through. So again, kind of a longish answer to your question.
No, we love long answers. It just explains the whole thing very, very well. Just one thing. So, for example, I'm just trying to understand if a BPCL is setting up a 49,000 capex plan up ahead. I know it's not just in the next 3 months, but let's say over the next 2-3 years. Do projects like these stand to gain help Thermax in some way if they are bidding? Are you bidding in some portion for something like that?
So tremendous. I think all of those, any big refinery expansion, modification helps Thermax, because anytime you do that, you tend to need power, you tend to need steam, you need a lot of ancillary units, etc. All of those are areas that we play in. Yeah, they're all competitive, and they all get decided on an L1 basis, where there are 2 to 3 players who get qualified. So those projects tend to help us quite a bit. But they have a long cycle. Once a project kind of gets defined, then you need to go through a big engineering phase. After you go through the detailed engineering phase, then the specifications come out. Companies like Thermax work with those specifications, but even from the specification to the bidding and the award cycle could take as much as 9 months to a year. Yep. So which is why I was saying the projects that are starting to firm up, but nothing for the next 3 to 6 months, nothing which is like 500,000 crores. Yeah. It's not like we don't have some big projects, but nothing that is 500,000 crores, the kind that we had multiple last year for. And last year, I mean financial year 22, not 23.
Yeah, understood. Okay, so you mentioned green solutions. There is a note from Macquarie which says that they're talking about what is different in your results, which is that increased borrowing, even though you continue to be a net cash company, and capital work in progress, which they believe is largely due to the green solutions business. Is that the correct understanding?
That is a very correct understanding, and which is why we wanted to show our business accordingly. The net working capital has gone up because right now we are setting up 2 big projects on renewable energy, and we have a lot of equipment which is work in progress for that. Similarly, as we look forward, we are borrowing, but we are borrowing specifically at the asset level in TOESL and FEPL, both of which are entities which have got much longer. TOESL is 10-year contracts, FEPL is 25-year contracts, where we put up the asset and own the asset. TOESL, the relative borrowing is less because it generates cash flows of its own. FEPL, the borrowings are quite significant. Both of these are borrowings at the asset level with no corporate guarantees as such. Yep. So these are projects that are operated where each project needs to go fund itself. And depending on the project, the portion of debt ranges from 70% to 50%.
Got it. Now, I heard you say that not too much for the next 3 to 6 months. You're waiting patiently for some big projects to open up. I'm trying to understand the way you are waiting. others must be waiting as well. And therefore, I'm trying to understand the end markets. What is the kind of competitive intensity that you anticipate when these projects do open up? And therefore, what does it do to the IRRs, to the margins? I know margins are also a case of what raw materials do, but I'm just trying to understand, because would you need to bid aggressively and be aggressive in pricing? How can you tell us about that?
No, I don't think we will be aggressive in undercutting or looking for pricing at all. Yeah, we have relative scale, and the focus will clearly be on profitability and the ability to show differentiation to get volume. Yeah, we are not in a place where we have concern on being able to fill up our plans, and so the focus will clearly be on profitability. One trend I would like to call out, which is unfortunate, and it is actually been happening for the last 3 months, and something to watch out for, is that India's capital goods industry was in large part free of the Chinese, in the sense that we are extremely competitive, capable. We win projects all across the world. But lately, and the cement industry is a good example, where a couple of the biggest projects in the country are seeing Chinese coming in, dropping prices, using front ends which are interesting in my words, and starting to show up in India. And while in steel there are barriers which they cannot dump, but they are using the product route to come into India, and they're being successful. So it's quite concerning in that sense.
Is that predatory pricing in some sense, Ashish, which the government needs to take note of and do something? Or is it just the Chinese saying that let's undercut?
I would say definitely. Yeah, we should, and we will be making our voice heard in this particular case, because it's not done clearly, and it's also a little disappointing that some of our biggest customers are looking at some of those routes for getting some of their projects done. So there's enough activity, but what is happening is, as China's own domestic consumption is not keeping pace, they're looking at markets that are lucrative outside, lucrative from a volume perspective, and the steel dumping game is just changing shape and color and showing up in different forms.
Well, I wish you success there. Ashish, just one last very quick question. I know we run out of time, but one last question. So does FY24 look to be a tale of two halves? The first half, from an order inflow perspective, not that great. Second half, maybe good order inflows. And therefore, part two of the question rolled into this as well. How do you think?
No, I wouldn't be that pessimistic, and I don't know what the second half holds. Yep. So a 23 crore, 22,300 crore order book for Q1 is something that I'm quite pleased with. It's not anything to look at. It may not have any of the super big orders, but we see a lot of activity on the ground. We are flat out in many, many ways. So, and if the big orders don't come as we work through, that's perfectly all right. And the other thing I would say is, see, for some of those big projects to even come in Q2, Q3, Q4, wherever they may be, a lot of the hard work happens now. Yeah, so my focus is on the work that we can do to establish ourselves, differentiate ourselves, which means we're doing a lot of work on pre-engineering, doing all of that, working with customers. The end goal, we really can't help as much. Here we can focus on the effort that we put in. And from that sense, we're quite busy now. Very, very busy.
And we wish that this continues and improves. Thanks so much, Ashish, for speaking to us today. Much appreciate your time.
Thank you. Thank you for having me.
The pleasure was ours, and viewers, thanks for tuning in.